from a cyclical hope perspective, it looks like, we're going to see housing kind of bounce around as a reflection of what rates do. I think PMI is going to improve, which all else equal should keep interest rates elevated on the long end. Profit breadth should improve on the back of rising PMIs. Those go very much hand in hand. And I think employment is probably, at least for now, plateaued at this high level of or at the current level of unemployment. Could we see a weak data month? Sure. Could we see a strong data month? Yeah. But I think we're stabilizing, and it kind of follows suit. And there's a lot of unknowns which could change the path. And like the Fed, we're going to have to be a little data dependent still. From my lens, there's not a lot of risk priced into markets. And what that means, at best, multiples could stay high, but are going to be a lot more volatile going forward.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. Today's guest is best known for his HOPE framework, a highly effective way to measure the health of the economy and to tell whether it's getting stronger or weaker. Well, as we begin a new year with record housing unaffordability, trade wars, and a cooling jobs market, what does this framework tell us is in store for 2025? To find out, we've got the good fortune to speak today with Michael Kantrowitz, Chief Investment Strategist and Managing Director at Piper Sandler. He's also recently launched a new podcast titled What's Next for Markets. Michael, it's great to see you again. Thanks so much for joining us today.
Good to see you, Adam, and thanks again for having me on.
Hey, it's always a pleasure, my friend. Look, I've been having a lot of people really the past couple months say, get Kantrowitz on. Got to find out what's going on with the HOPE framework, especially as we're coming into this new year. New year is categorized by super high valuations in stocks, at least. A lot of change and uncertainty with the new administration. I mentioned in the intro here, record housing unaffordability. Trump is sending 3 to 10 curveballs out a day that are spinning heads about what might happen with the economy, with tariffs, et cetera. And the jobs market, Jerome Powell would say it's been normalizing. Some other people would say it's cooling. I know these are all factors that go into your HOPE framework. So super excited to get the latest update on what your framework is telling us. Real quickly, before we get to that, if we can just kick things off with the general question I'd like to ask you at the start here. What's your current assessment of the global economy and financial markets?
Sure. I think the global economy is still remains uncertain, given all those things you just mentioned. But certainly in many of the developed economies, I think we're starting to see some stabilization in pockets that have been weak for the last several years. Most visibly in the United States. And I think between the outcome of the election, the Fed cutting rates 100 basis points, there's some sense of renewed optimism. And when we look at the global backdrop or the US backdrop, I would say that we've been in a very bifurcated macro economy and bifurcated market backdrop for the last several years. And I think that in 2025, so the weak part of that bifurcation will hopefully start to heal somewhat and improve, and that we should see somewhat better breadth around the global economy and certainly within the U.S. economy, and unlikely to see a market that's just led by 7 stocks this year.
Okay, so I want to give you kudos that you have this term of bifurcation. You've been beating that drum for a good while. I think that really has been a very major theme. I think it's in many ways a theme that perhaps carried Trump into office with the majority of the popular vote that he had, because the bottom part of the K in this K-shaped recovery or bifurcated recovery we've been having, there's a lot of anger and frustration in that bottom part of the K, which I think we could maybe safely say is 80 to 90%, sadly, of the public. So what makes you think that the weak part of that bifurcation is going to start improving this year? What's giving you optimism there?
Yeah, well, when thinking of catalysts, I always start off with, well, what was the catalyst to make those weak parts of the economy weak? and therefore understand, well, okay, this was the problem, and then ask ourselves, is that problem starting to resolve itself? So I think, when the last couple of years, there's been a lot of debates around whether the economy is rate sensitive or not. And the Fed's rate tightening cycle certainly slowed many parts of the economy down a lot, but didn't really have a very clear negative impact on the broad economy.
Mhm.
But I think, again, that's the difference between looking at something like GDP overall or the S&P 500 overall versus looking at underneath the surface of the parts. So everyone knows the market's been very bifurcated, and the Mag 7 have been leading the charge, and that's largely been because earnings growth outside of the Mag 7 have been quite weak. And then when we look from a macro perspective, the services part of the US economy has been holding things up while the manufacturing part of our economy has been in contraction for the last 2 years or so. And we also saw similar type of weakness in small business activity and small cap earnings. We've had 3 years of consecutive or back-to-back-to-back declines in earnings. So why has that been the case? Well, I think, yeah, the Fed raised rates pretty sharply, price levels picked up, and essentially those companies, consumers that were paying higher interest expense really bore the brunt of that. And those companies and consumers that didn't have as much, let's say, operating leverage or economies of scale, similarly kind of paid the price of that. And so now we have the 100 basis points lower Fed funds rate. Commodity prices have been fairly weak. The market's up a lot. Home prices are up a lot. And so I think those parts of the economy that struggled from the Fed tightening will, in kind, start to improve from the 100 basis points of rate cuts we've seen.
Okay, and is it just the rate cuts on the short end of the curve, or is part of your optimism based in an expectation that longer term yields may start coming down this year as well?
It's more the short end. And if you think about which parts of our economy are more impacted by the long end, that's really housing, when we go up beyond 10 years of duration. Whereas, if you were to ask me why the Fed cut, I think and I would simply point to small businesses. The Fed didn't cut because the S&P 500 was weak or GDP was weak. They cut because the lower end of the consumer in terms of income has been struggling, and smaller businesses have been struggling, and they essentially pay, in terms of lending, they borrow at usually in interest rates that are derived from the Fed funds rate or the prime rate. So whether it's credit cards, HELOC loans, business loans, small mom and pop shops, they borrow from their local bank, which again usually will set that on prime plus. So 100 basis points lower, the help or the tailwind from that is going to be really geared towards them. I don't really think the 10 years got a whole way to go lower. I think we're going to be bouncing around 4 and 5% on the 10-year for the foreseeable future. What could break us down below that range? A sharp rise in unemployment. I think we're starting to see the labor market normalize and firm up. What could push us above 5%? Obviously, another inflation shock, perhaps, however it came about. But I think the odds of that are also quite low. And so I think we're going to be bouncing back between those levels. Also, banks have eased lending standards over the last year as well. So that's another less followed data set that comes from the Fed's Senior Loan Officer Survey. So I'd say a combination of that, plus commodity prices have been low, energy prices have been quite low, gasoline's been low. So I think at the margin, we've got more easing in the pipeline than we've had really since COVID.
All right, Michael, look, lots of questions from what you just mentioned there, but as you said earlier, you're the kind of guy who likes to roll up your sleeves, look under the hood. That's what the Hope Framework is really helpful in helping us do. So we'll walk through what your Hope Framework is telling you in just a second here. Let me ask you this. So if I heard you correctly, you think that one of the things that's going to provide relief this year is the fact that the Fed has started lowering interest rates. Get a sense for you in a little bit if you think they're going to be able to continue lowering them throughout the rest of the year as well. But what's interesting is uh, one of the things that seems to have had a lot of explanatory power, at least a lot of the folks I interview say, has been liquidity has been net positive over the past 2 years. It's one of the things that really kept us out of recession when everybody thought we were going to fall into recession starting in 2023. And the narrative is, well, the Fed's been in this tightening regime. They've been hiking interest rates. They've been doing QT. Therefore, the Fed is draining the pond. Well, first off, regardless of what the Fed was doing, on the fiscal side, we've been filling the pond, lots of liquidity
Yeah.
there. But
Yep.
even on the Fed side, there have been things like the draining of the reverse repo program, right? The creation of the BTFP. So things that actually were liquidity stimulus, and I'm not saying you have to agree with them, but certain analysts, Michael Howell being one of them, who has his
Mhm.
own measure of all this, believes that certainly collectively, Fed and fiscal policy have been net positive. But even on the Fed side, he thinks it's largely been net positive despite the tightening and the QT. So where I'm going with this is, here in 2025, we've got perhaps a change in policy on the Fed side. The reverse repo program or facility is pretty much empty at this point, but we also have a massive refinancing wall of debt, both on the government side, but also in corporate America side. And yes,
Yep.
the Fed has brought rates down 100 basis points, but right now it looks like corporate debt's going to re-rate at a substantially higher amount than these companies right now are sitting on really cheap debt they took out several years ago. That all acts like a liquidity sponge. So I guess my question to you is, do you have any concerns about the shifting liquidity environment and the fact that it could actually, you know, create some economic headwinds here as liquidity starts at least not growing as fast as it was, or maybe even receding?
Yeah. Well, so I do expect interest rates again to kind of to stay between 4 and 5%. And I do anticipate that the Fed's probably done. Again, maybe we've got one cut left, really coming from a good inflation data point, but I think the Fed's essentially done. I think we can just look at interest rates and see how interest rates have been pretty strongly negatively correlated with equities, particularly over the last 3 or 4 months. And I would argue that if rates stay above 4.5% and rise, that's going to be a big headwind for equities, particularly pushing multiples lower. So I don't think we need a whole lot of tightening or rates have to go up a whole lot, because if you look at where credit spreads are, look at where market multiples are, yeah, they're still kind of priced for a backdrop that suggests rates are going to fall a great deal further. And if rates stay where they are on the 10-year yield, and if the Fed is indeed done, then I think we'll slowly see multiples grind down. And obviously, if inflation or growth more rapidly accelerates, then rates are moving higher. And I think that's going to kind of re-squeeze those weak parts of the K-shaped, the weak parts of the bottom of the K. So yeah, the small caps are not out of the woods yet, and mid caps that have refinancing. Nobody's moving in residential real estate world. It's becoming more regional, but total home sales are still decent below 5 million. Commercial real estate still has refi risks. So by no means are we out of this problem that is still largely ahead of us in terms of rising interest expense and rising debt costs and the problems we're seeing in the housing sector.
Okay. Well, look, I've held off long enough. I know folks are saying, look, get straight to hope. Those that are aware of the framework. So let's get there next. Just real quick, we'll come back to talk about this in greater depth. But what I'm hearing from you, Michael, is a sense of the fact that the performance of the financial markets this year, at least stocks, is not going to be as euphoric as the past 2 years have been. That we're probably not likely to see another 20+% up year.
Yeah, and I think again, keeping it really simple, market's not really pricing any risk. And you could argue and say, well, you disagree with me, and that's fine. But when you look at credit spreads at 25-year lows and large caps, near 20+ year highs in terms of valuations, And even small caps, they were trading at 11 times earnings in 2022 at the lows, and now the S&P 600 is trading somewhere near 16 times forward earnings. So, yeah, that's less than large cap, but I think appropriately so because the small cap index is more cyclical and lower quality. So, from my lens, there's not a lot of risk priced into markets, and what that means, at best, multiples could stay high, but are going to be a lot more volatile going forward because you don't have this problem everyone's focused on that could, just kind of grind away over the next 9, 12 months. Maybe tariffs don't happen, but again, we're near still all-time highs on markets, and so it's hard to argue that tariffs have had a huge negative impact on equities that could provide some relief if it goes away.
Okay. All right. Like I said, we'll get more into that near the end of this discussion,
Sure.
folks. All right. So I've now mentioned your hope framework several times. Michael, could you just give a 20-second overview of what the hope framework is for the few folks watching that haven't watched before and may not know that it's an acronym and that it stands for several different important components of the economy?
Sure. Let me try to see if I can. All right, Adam. So the HOPE framework, it's an acronym. It stands for Housing, Orders, Profits, Employment. This heat map here that I'm showing is actually based on quantitative data. It's looking at business cycles going back to the 50s or 60s, and the impact of each one of these pieces of macro data up here on the top of this panel in terms of how it reacts to changes in Fed policy, changes in interest rates. So you see housing, obviously a very rate sensitive sector that often reacts pretty quickly in terms of when mortgage rates change, which is then followed by orders. So that more broadly kind of speaks to leading indicators of the economy like the ISM index, the PMIs, consumer new orders, and then those leading indicators then spill over into coincident indicators, which I would say profits, industrial production, capital goods orders, and then that's followed by employment. So it's kind of the supply chain of the macroeconomy. And we use it as just kind of a simple way to think about what these major milestone points of the economy are doing, as it helps us to understand, when the Fed is easing or when they're tightening, what may follow that. And having these checkpoints along the way helps us to gauge probabilities a little better, whether or not the economy is going to broadly improve or be more bifurcated or go into recession. And so the most recent hope cycle, beginning really in 2022, was that we had a Fed tightening cycle. Housing collapsed in 2022. And when I talk about housing, I mean activity. So building permits, mortgage applications, housing starts, new home sales. And then that was followed by in 2022, all the manufacturing PMIs were at near record levels, collapsed over the next year and change. Profit growth slowed, of course, in 23 into 24. Particularly if you take out the Mag 7, profit growth was pretty much zero those 2 years. Obviously, the Mag 7 contributed to a lot of profit growth, but that's ultimately why those stocks drove the market. And then employment, we certainly haven't gone into recession, but employment did certainly soften, weaken. There were parts of the employment backdrop that were much weaker than others. But again, the economy, the result of the Fed tightening cycle led more to a bifurcation than a broad-based decline in the economy. So that's kind of where we've been. If I think about it today, here are just a few charts that kind of show one data point to represent each one of those four pillars. And so over here on the left, what we've seen basically, what I'd say housing has been in is somewhat of an L-shaped bottoming. I want to call it L-shaped recovery, but L-shaped recovery doesn't, seems like an oxymoron. So it's really been more of this kind of, big decline in 2022. And here I'm showing builder sentiment, the National Association of Home Builders. So you could see it kind of bottomed out in 2022, and it's just been kind of zigzagging between 55 and 35 over the last few years. And so I would say that's been kind of an L-shaped recovery, and that reflects, the affordability crisis we currently have in most of the nation. PMIs or orders, Again, those tanked in 22, but are actually back into expansion territory for the first time in several years. Profit margins are starting to, and earnings revisions breadth are starting to broaden out a little bit. We're actually, for the first time in 2-3 years, seeing small cap forward earnings estimates start to improve, and same thing for mid caps. And then, as I said earlier, employment, the unemployment rate did go up from 3 and change to about 4.3%. And it was remain low enough to obviously not broadly hurt the economy, but it did follow the sequence. Um, the tough part about any macro analysis is getting the direction is half, probably more than half the battle. And then getting the magnitude on top of the direction, that's really the cherry on top of the sundae. And my hope framework, is more directional and looking for inflection points. Magnitude is really hard to model because cycles can be so different. How could we have modeled the fiscal impulse for the last couple of years? We knew it was positive, but did we know how positive that element would have been? So again, a lot of reasons the employment backdrop didn't more broadly or more sharply deteriorate. And as we sit here today, I think the worst is behind us from at least the parts that weakened from the tightening cycle. I would expect unemployment to kind of trend sideways here, kind of plateau at these levels, roughly around 4.1, 4.2%. I'd be surprised if we fell real sharp. And I also think that would potentially lift bond yields higher than where they are now, which could be problematic. So that's kind of the overall summary, and we can dive into any one of these.
Yeah, let's dive into them all if you can. And I've
Sure.
got so many questions. Do me a favor, just go back up to that chart just for one sec. All right, so I sort of look at this and listen to your explanation there, Michael, and to me it seems that housing is, kind of in freeze right now. It's in deep freeze, right?
Yeah.
The L shape, whatever you want to call it, it fell. It's still on the floor. It's still just kind of rolling along the floor.
Yep.
Orders and profits, we could maybe put those in the green shoots category.
Absolutely.
Okay. Unemployment, I would say TBD, although I would, and I'm not the expert you are, it seems like you said you think the worst is over. But I don't know if we've necessarily seen a reversal of trend yet. And so let me ask you two high-level questions, and then we'll go through all the granular data. So one on housing is, so we've seen transactions, like I said, go into deep freeze, housing activity go into deep freeze, as you said.
Yeah.
But we haven't seen prices correct.
Correct.
Right?
Yep.
And what do you think is more likely to happen here? Transaction volume to recover, and we just go back to a healthy housing market, and there really isn't a material correction in pricing. The clouds part, the sun comes out, and we're fine. Or do you think, as transaction volume inevitably increases at some point, as it must, that additional inventory is going to pull prices down with it?
Well, I think, it's really hard to talk about anything in aggregate these days. Again, going back to the bifurcation I was talking about.
Yep.
And so to me, it's such a more interesting discussion to dig into the segments that pull together all these aggregates. So employment, I would say, we're definitely seeing green shoots now. And again, in terms of direction of a lot of the labor data, that were a lot of that were giving us warning signs, in 2023 and 2024 that the unemployment rate would go up. And, I'll fully admit I was in the recession camp up until late 2023 in October, and then changed my call because I kind of had a realization of one of the things I was missing on the market. But also when I look at the economic outcome, like unemployment still went up about 1%, which historically has never not led to recession. But of course, this cycle has certainly been different for all the reasons many people are aware of. So we got the direction right, but the magnitude obviously was not, was much less than I would have thought. And so, people often ask me, well, is the hope framework broken because we didn't have a recession? And again, it's not about calling recessions at all. It's useful in a soft landing or understanding what a soft landing is. It's just a soft landing is basically where E does not contract. And, we haven't had that yet. But a soft landing begins with housing. So the housing backdrop today is more unusual than I think anything we've ever seen. And so that's one of the things that I'm trying to figure out is, okay, if we're seeing cyclical parts of the economy improve, like the ISM, and that typically leads to higher interest rates, and higher interest rates is keeps the housing market frozen, what kind of landing are we getting in this cycle? Because every single period historically where manufacturing PMIs have gone from contraction to expansion was either preceded by or coincided with a sharp rebound in housing, which was preceded by a Fed easing cycle. So we did get a Fed easing cycle. We can debate, how much it was, again, magnitude versus direction. But I don't think the Fed's eased enough to change really anything in the housing backdrop. I also think the housing backdrop's becoming more regional. Basically anywhere there's supply, home prices are falling. Parts of Florida, parts of Texas. I know you speak with a lot of people that are experts on this area, highlighting all the completions that are coming online. And so the housing backdrops, I would say, gotten worse from the past 2 years, even though some of the activity data is kind of stabilized because there is growing supply, and now you are seeing prices fall in some pockets of the economy. My neck of the woods, I'm in the Northeast. There's no inventory. Home prices are not falling whatsoever. So you have this unique backdrop where people are stuck in their homes. You've got homeowners that have a ton of home equity that they could tap, and they're starting to. Home equity loans growth is up 9%, which is the fastest since before the GFC. So people are starting to tap their home equity loans. So that provides more money for the consumer. And then with regards to those would-be homeowners that can't afford a house today because the price level's high and interest rates are high, maybe they'll just continue renting and use some of that saved up money for housing elsewhere. There's plenty of folks that are, I hear from the younger generation that kind of given up on buying a home, and perhaps that money gets used elsewhere. So I think it's really going to be interesting, and I really don't know what it's going to look like because there's no historical examples, but we're not going to obviously see this huge refi cycle unless rates fall a lot more. I don't see rates falling a lot more unless unemployment rises sharply, which I don't really see from here. So I think housing is going to be kind of a non-factor from an activity perspective, but those that can't afford a house or have a lot of money in home equity that they could tap could provide a lot of spending power elsewhere.
Okay. I'm wrestling with whether we just want to just go through these in order here, because I'm trying to jump. My heart wants to jump to the E and have a big discussion with you about that, but I wonder if that's putting the cart before the horse here.
I can try to keep it more succinct.
No. It's all great. So tell me. Okay. So you've said, look, it's sort of an unprecedented time in housing here. Let me just say this. What are the things that you were looking at most to try to give you a sense of where housing is headed from the hope framework standpoint, whether it's going to be helping or hurting the economy?
Yeah. So from an activity perspective, certainly interest rates, total home sales, existing and new, mortgage applications for purchase mortgage applications, much more important than refis. And the builder sentiment data that I was showing you earlier. So, when we look at consumer sentiment around housing, basically we're at the second highest levels in history of consumers telling us it's a bad time to buy a house, only eclipsed by 3 months ago. So 83% of consumers are saying it's a bad time to buy a house. And we know why, because the affordability numbers are just completely out of whack. So that's new home buyers on the left. On the right, I don't need, how much home equity has been created over the last several years with home prices up nationally 40, 50%. For the first time in a long time, home equity, equity withdrawal is growing. And it's 9.1%, which just kind of beat out, I guess, this other number we probably hit in early 2022. And it's the highest growth rate in home equity loans since 2007. I don't think at all this is going to look like that what we saw in the housing bubble. Just the fact that it's a positive, obviously, is a big change. And this is kind of, to me, one way to show, look, the Fed cut, and HELOCs are usually a function of what the Fed, the prime rate is. That's down 100 basis points. Maybe some folks, are running out of money. And so instead of paying 20% on a credit card, you can pay 7, 8% on a home equity loan, a lot cheaper.
So that's exactly where I was going to go with this question here, which is, do you take this increase in home equity loans as a sense of, all right, people can afford to take money out of their home now, and this is a good thing, and it stimulates the economy? Or is it more of a negative, like, hey, people are really struggling, and no matter what home equity rates are right now, they're just having to turn to wherever they can get capital right now?
I think it's a little of both. One, I mean, I see this in my own neighborhood. Nobody wants to move. And so if you bought a house thinking, okay, I'm going to own this house for 5 to 7 years, and you had a couple more kids, and now you can't afford to move, you're going to maybe do an addition instead of moving. Because, if you had to do an addition, let's say you had to borrow a few $100,000 from home equity, that's going to be a lot cheaper than buying, replacing your entire mortgage, which is likely more money. So I think part of it would be for good reasons. And that's kind of, again, these things we have to think about now that are different from the past. And so we definitely see that happening a lot. My wife's an interior designer. She has her own business, and that's where some of the demand is coming from, that people can't afford to move. So they're adding up, building out. And I'm sure, too, there's consumers that are making the smart decision that need to borrow, doing it from their home equity rather than using a credit card or a personal loan, which is definitely going to be a higher rate. But I guess in aggregate, I see it as a positive more than a negative.
Okay. All right. But in general, for much of the rest of this year, I mean, feel free to go through anything else you have here, but in general, for the rest of the year, it sounds like you're saying housing probably not going to be as material a factor as it has been in past points in the cycle, just because it's still in the process of kind of trying to pick itself off the floor.
Yeah, I mean, every week, I'll just pull this up my Bloomberg, is the MBA purchase activity. So this tells you every week how many people filed for new applications for mortgages to buy a house. And, it's been bouncing around the bottom given whatever mortgage rates are doing. And obviously mortgage rates are down a bit in the last 3 weeks. And so, we're at the high end of the last 2 years, roughly, which is not surprising given that mortgage rates are down since the middle of January. But, when we look at this longer term, it's not really that meaningful.
Yeah.
And if it takes lower rates to get you higher, well, what does it take to get much lower interest rates? I think weaker employment, and we'll get into that in a second. So that's some other data. And so here's, again, the unique aspect, though, and I wish I had this chart going back longer in time, but I promise you that what I'm going to say is true, that every single other historic PMI acceleration, which we clearly have today with the ISM new orders at 55, has coincided with housing basically doing the same thing. Usually right before, like if you look at 2019, when Powell pivoted, I mean, housing, boom, immediately turned back up in January of 2019 and went soaring until COVID. So that's the kind of thing you usually see when the Fed pivots. And we definitely have not seen that. So it's going to be a unique cycle. And I'm trying to keep in the back of my head what this could mean and where things could be different because of it.
Yeah. And I'm just curious, do you suspect that the reasons are more macroeconomic, or could it be that we just pulled so much future pricing in the housing market from the future into today during COVID that we just have to burn it off for a couple of years?
Well, I think it's this top left chart. It's affordability.
Okay, so it's essentially kind of
it's
a buying
yeah,
strike on the bottom half of the.
I don't know if if it's a question of want to or not want to. I think it's more of a question of can or cannot. If you can't afford something, then maybe what people can afford today is not what they want. And I feel for people that are in their mid 20s or early 30s and looking to buy their first home. I remember the backdrop when I bought my first home in about 12 years ago. And I can only imagine today, the struggle with such limited inventory and such high competition and such high home prices and interest rates.
All right, so we'll move on to the other parts of the HOPE framework in just a second, but I'm going to ask a question I asked earlier just a second
Yeah.
time. So and maybe I'm pushing you to speculate a little bit here, but how does this correct in housing? Does it correct with a price correction, or does it correct with economic growth and wages just pick up enough that all of a sudden a lot of those people who can't suddenly can?
I think it's more likely time. I mean, I think there's going to be, again, it's becoming more regional, the housing backdrop, where it was, I think, broadly a very correlated story around the United States a year or two ago. And now there's definitely areas where you had the most excess starting to show signs of weakness. But I would say for much of the country, it's going to be time, not a sharp decline in interest rates, not a sharp decline in home prices, or not a sharp increase in income. So I think this is a new normal here to stay. And again, it's not a bad thing necessarily. It's just going to make the outcome of when the Fed cuts or tightens, as we've already saw in the last couple of years, home prices didn't budge. They went up as the Fed tightened. So I think we have to think about, this continuing and how it's going to be different with the Fed easing cycle behind us.
Okay, and just to make sure I'm following, there's some folks I talk to that are sort of predicting a bit of a lost decade ahead for stocks, right? That valuations got so heavy, that or got so high that the markets will likely kind of move. The annual returns for the next decade are going to be quite low. That's what they're predicting. Are you making sort of a similar call for housing? And I know you said, look, it's different regionally. So obviously, real estate's super local, but sort of nationally, do you see prices just moving sideways as eventually more of the population gets enough wage growth to where they can start affording this again? It might be 5 years, 10 years, whatever.
Yeah. I think it's going to be very sideways and very reflexive given where mortgage rates go. As we've seen, what happened in the third quarter of 2024 was that interest rates fell 100 basis points because you had unemployment go up for 4 months in a row, but the unemployment rate was still low at 4.3, which was the high. And so a few people lost their jobs in those 4 months, yet everybody enjoyed the benefit of a 100 basis point decline in the mortgage rate. So you essentially saw people jump back in and purchase applications activity improved, but home prices went up because the inventory backdrop really didn't change very much because, again, it was a small negative hit to the economy. It wasn't broad enough. So yeah, I think it's going to be more a function of time. And just to give you like a simple parallel, think about equities and homes. Right, homes are far more expensive than equities. Like everyone's worried about equity valuations. Well, they must be freaking out about home valuations, right? The highest home valuations to any metric in history, to income, and so there's a parallel though. Home prices are high, and the house I own, is it overvalued? Absolutely. What's the fair value? Whatever the value is that someone's willing to pay for it. How did it get here? Well, in my neighborhood, there's 12 homes for sale. When I bought my house, there was like 100. So again, going back to the rationale, why are home prices up? Well, there's no inventory here and interest rates are high, and that's going to likely keep that persisting for a while longer. So just like for equities, when we look at the valuations, it got there for some reason. And for equities, again, it was inflation rolled back over, the Fed stopped hiking. We didn't have a recession. So equity valuations are, again, back above 20 on the S&P. They're going to stay there unless a new problem shows up. And my home is going to remain at the ridiculous price, and it's not me, it's everyone, until more inventory shows up and there's nowhere else to build in New Jersey. So I think for both of these, you can think of the valuation catalysts. Unless something changes, they're going to remain there. For equities, the typical valuation compression catalysts are a spike in interest rates, a spike in employment, or some kind of geopolitical global currency shock, or something exogenous. I don't think employment's the risk I thought it was a couple of years ago. I think interest rates is the headwind for equities going forward every time we get above 4.5% and keep going towards 5%. And looking around the world, I mean, there's plenty of things we can point to that could, cause problems. We've got a couple of wars going on, a lot of uh, tariff tension, to say the least.
Right.
So, but we can't forecast all that.
Okay. So I guess those are the two things I want to zero in on. So uh, orders and profits, or sales and earnings, however you want to think about it.
Yeah.
So those are green shoots.
Yep.
So tell us anything you want to tell us about, what kind of optimism that's giving you for the rest of 2025. But if you can, let's throw the uncertainty of and not even really uncertainty. I mean, there are tariffs now. The morning we're
Yep.
talking about, President Trump just announced what, 25% tariffs on steel and
Yep.
aluminum.
Yep.
And then of course there's the other tariffs that he's imposed, paused some, whatever. But it looks like we're probably going to have even more in the future than less. So what impact do you think that may have on the green shoots that we're seeing here on the sales and order activity side?
Yeah, well, I think it goes to the question of why these orders are picking up. And I always try to corroborate data sets to better understand what the drivers are. And so there's certainly pull forward going on in from these tariffs that has probably been taking place since Trump got elected. And you're seeing it in consumer areas, housing related, things that are built and manufactured in China.
All right. And so, sorry to interrupt you, but this is, here,
Yeah.
let's buy all this stuff now before Trump maybe slaps tariffs on it. So we'll hopefully be getting it cheaper in the immediate time frame. Correct?
Yeah, you're getting consumers that are purchasing ahead of tariffs, and you're even getting companies that are moving their supply chains ahead of tariffs, which in some cases is actually causing some prices to increase because they're going to a maybe a higher price supplier that won't be tariffed. So ultimately, they may end up being the lower price supplier or manufacturer. So there's definitely a lot of volatility. And you see that every month. So we look at PMIs, and there's a lot of regional PMIs, the Empire Fed, the Philly Fed. And each month when these data sets come out, there's reports that these either Fed districts publish or the ISM publishes that have company comments. And they've been littered with tariff concerns regarding pricing and prices for the last several months. So it's all, there's definitely an expectation that it's going to be inflationary or price levels will increase. So a question we get asked a lot is, are orders just reflecting this pull forward?
Right. Are they really
And
green shoots, or are they just
yeah,
sort of being manipulated? Yeah.
yeah. And so the answer, I cannot dismiss how much of the orders are coming from, or I can't quantify how much of the orders are coming from pull forward. I mean, we certainly see evidence and anecdotal data, and it definitely seems reasonable. But what I can quantify and corroborate is the typical, consistent historical behavior of Fed policy changes and PMIs and bank lending standards and PMIs. And so if you look at the chart here on the left, we'll start there. That is a chart of the ISM new orders and banks lending standards. So that darker blue line is the ISM, the gray line is lending standards. And as they both rise, stronger ISM and easier lending standards. So the thing about banks is that they behave very pro-cyclically. When the economy gets better, banks tend to loosen up their lending standards. When the economy gets worse, they tend to tighten their lending standards, which is why we need a Federal Reserve. Regional banks are not the lender of last resort.
Mhm.
So what you see here in the last year or so is that you've seen both, and particularly in the last several months, you've seen both rising PMIs and easing lending standards. And so that suggests to me, or at least corroborates the idea that some of this is just coming from a better economy. Because again, this kind of easier lending standards suggest that banks feel better about the outlook. So that's one part of it. The chart on the left is again one of the elements of why we have a business cycle, which are twofold: changes in cost of money and changes in the cost of goods. And so this is an example of the changes in the cost of money. This is a diffusion index of global central banks. And the light blue line basically tells us how many global central banks around the world are easing versus tightening. And we've gone from a pretty extreme tightening cycle, which probably ended in terms of rates of change some point in late 23, early 24. And now for the last 12 months or so, we've seen everyone shift over to the easing side. So this year, we made a big change to our recommendations for positioning on the economy, largely because global central banks have went from tightening to pausing to easing. And that is the time where you should finally start to see this more cyclical manufacturing data improve. People have been trying to call the bottom in PMIs for, since 2022. And while, they did bottom out in late 2022, they kind of stayed sideways, kind of had that L-shaped recovery until this year. And this year, for the first time since 2022, the ISM manufacturing index is above 50. And to me, that's happening in large part due to the easing cycle. And I expect PMIs to not move up every month, but improve throughout this year. I don't think we'll shoot the moon and go to 65 on new orders, but I think we could see a modest improvement from here.
Okay. All right. So you're detecting, a decent heartbeat here now, or a stronger heartbeat here, just sort of in the commercial part of the economy. All right. So as we go to profits, if I remember from your earlier chart, somewhat of a similar story, correct?
Yes. So profits, I think, the story's been simple. We've had this massive bifurcation, from Mag 7 to equal weighted to large caps to mid caps to small caps. So everything has been bifurcated. Even sectors, you've seen big winners and big losers. So on the left side here, I'm just showing the evolution of earnings estimates beginning in 2023. And that's on the left scale of that chart and how those have evolved.
That's the size matters chart, right?
That's the size matters chart. Yeah, absolutely. But what we've seen, we a few weeks ago during earnings season, I'm not sure if it was Google or Microsoft, but a couple companies, their estimate revisions have been pulled down a bit. So that's what you're seeing in the mega cap and large cap. I think the equal weighted S&P, which is not on that chart, has pretty much gone sideways. So it kind of, again, probably a Mag 7 story. Whereas mid cap and small cap earnings, forward 12-month earnings numbers are, for the first time, really both improving. So this is the bifurcation that we've had that is starting to become, I don't know what the opposite of a convergence, somewhat. So we are seeing this moderate improvement in breadth, and this is what the chart on the right illustrates. And this is why we use PMIs. And we did our podcast last week on PMIs and the kind of uses and misuses of PMIs. You don't use a PMI for recessions. They're really a measure of breadth of the macro economy. It's, we use the ISM manufacturing index. So it really captures the volatility and the breadth in the economy. The ISM is a diffusion index. So you could see it correlates really well with the percentage of stocks in the S&P 1500 seeing positive earnings revisions. And so the simple conclusion is better PMIs, better earnings breadth. And so as I think about this year, I don't think the economy is going to necessarily get stronger, but I think it's going to get broader. And the latter is what actually matters most for positioning.
Okay. So it's been a pretty rough couple of years in small mid caps. I mean, honestly, in the S&P 493 and anything smaller than them, right?
Well, yeah. And if you look at that orange line on the chart on the left, small cap earnings have, I'm showing 2 years here, but you can go back. They peaked in March or middle of 2021. So any gains you've seen in small caps have all come from multiple expansion.
Got it. Okay. So, which is a sign. It's not necessarily a sign of a healthy economy or a healthy market, right? Where what I hear you saying right now is, again, maybe you're detecting that the heartbeat's beginning to strengthen with all the other companies that have basically kind of been treading water, sucking wind for the past couple of years. Still early days, but this is the type of thing you would expect to see at the start of a resuscitation of the economy, correct?
Yeah. And so again, like, I'm not talking about a massive shift, a complete reversal of macro and micro leadership of the last 2 years. Like, this is not as that drastic. I'm talking about, look, we have to acknowledge we've seen a marginal improvement and everything trades, and we're looking at data at the margin. And so if there's going to be an improvement in macro and micro breadth, this is where it should start to happen this year. Again, going back to breadth and magnitude, direction and magnitude, how strong will this be? I don't think it's going to be, super strong of a move. But again, when we're talking stock prices, you just need some upside surprise to get a stock moving higher. But again, going back to what we were talking about earlier, I think, yeah, interest rates are going to, on the long end, remain fairly elevated between 4 and 5%. I think the Fed's more or less done. And I don't think housing is going to see much of a contribution to the economy. So it leads me to a much more modest improvement in breadth, but an improvement nonetheless, which is, again, enough for us to change our recommended positioning this year.
Got it. Okay. And remember, folks, too, we're talking about the economy right now, how that translates into markets. We'll talk about in just a moment. But obviously, these are the more unloved stocks. So as you said, even a little bit of good news can maybe make a positive difference trajectory-wise in some of these stocks.
Yeah. Well, think about it like this. Some investors now have a reason to actually broaden out their portfolios.
Right.
Whereas the last 2 years, it's all been on speculation. Look, the Fed's going to stop hiking. Now they're going to cut. Oh, look, CPI came down. Oh, look, we had a weak jobs number, and that's good for bond yields to bring that down. Like those have been all these failed rotation calls. They've all been macro. It is only sustainable when it comes from earnings and micro. And that's why we've not seen small caps have any sustained period of outperformance to mid caps or large caps, because there hasn't been the fundamental trend. Whereas now we're starting to see the green shoots of that being a potential this year. So that is a huge game changer from the past 2 years.
Okay. All right. So far, Michael, I've kind of been following all this. Like nothing here is shocking to me. I mean, maybe I from some other conversations I've had on this channel, these green shoots are a little unexpected, but I can certainly understand, why you're seeing what you're seeing. And again, you're saying, magnitude wise, these things aren't ferocious, at least not yet.
Yep.
Employment is the one I really want to dig into with you here. As we've talked about many times, sort of as goes employment, as goes kind of almost everything else. It sort of feeds back into the hope cycle, right? I mean, employment can impact housing, as you've said many times already this conversation. The employment market by, I think, almost every metric, although you would know better than I, has cooled over the past couple of years. Jerome Powell would call it normalizing, although even at his last press conference, he made the comment that he doesn't really want to see it cool anymore. And he said, "Hey, it's because the journalists were kind of pressing on it. You could tell that they seem to think it's a worse jobs market than Powell was publicly stating, and got Powell to say, well, it's a good job market if you have a job. It's a tougher one if you don't, right?
It's a good
and that is
housing
a
market
big change.
It's a good
Pardon
housing
me?
market if you have a house too.
Yeah, exactly. Great comparison. Great housing market if you have a house. But that was a big change, right? So past 2 years, it was always, there's just way more openings than there are applicants, and the quit rates was really high and all that stuff. All that stuff's now come down. The hiring rates come down. So, we seem to have had a cooling. The trend seemed to have been towards cooling. I'm curious if that's still continuing. I think we're seeing lots of articles, and maybe this is anecdotal, but I mean, look, there's been a steady drumbeat of layoffs. War notices have continued to be pretty high. We certainly see a lot of articles and hear anecdotally about how tough it is for people who are looking for a job to find a job now. But even more importantly, and this is the big question I've been waiting to get you on to ask you, is when you look at the jobs data that we've seen over the past year plus 2 years, part-time jobs have been where the growth is, not full-time jobs, right?
Yep.
And government jobs have been where the growth has been, not private sector jobs, right?
Mm-hmm.
So we're now seeing, and I know this is new data, so it hasn't necessarily been reflected in the data set you're looking at. We now have a new administration, right? That's basically saying U.S. government's not hiring anymore. In fact, we are taking a chainsaw to our staffing. right? You've
Yep.
had the 2 million public workers that were just given the buyout. We'll see how many of them take it. You've got Doge in there just trying to shut down all sorts of different departments. So my question is, if that's where the job growth has been and that tap is getting shut off pretty violently right now, would one expect to see the employment market kind of take a hit from that?
Well, again, we don't know on a lot of Trump's policies how they're gonna, well, what they're gonna end up, where they're gonna land, and how they're gonna work themselves out. Our policy analyst doesn't see a huge risk to the job market coming from there, but I think we also have to look at the rest of the labor market and look at the other areas that have been weak, as a potential offset if those are starting to get better. And so we're
Mhm.
definitely seeing some green shoots there. But again, like I'm trying to, I think there's more market implications than there are economic implications in terms of everything I'm talking about, because we're talking about rates of change here, incremental rates of change with PMIs getting a little better, the unemployment rate kind of plateauing. So these are marginal changes. I don't expect the labor market. I don't want you to get me wrong here to like strongly firm from here, i.e., the unemployment rate go back to 3.5, or the job openings numbers to shoot back up, or wages to accelerate sharply. I mean, there's again plenty of concerns that could lead to that. From what President Trump's policies are around immigration, what tariffs do to price levels and how that flows through to wages. But I think it's one of many potential risks that we're just going to have to keep an eye on. That, again, how are we going to, how do we handicap how many people are going to take buyouts? And if they get a buyout, well, they've got money for the next, right,
Eight
six,
months,
seven
so yeah,
months, 8 months.
yeah.
So remember what happened during 2022, I believe it was, or when we had a bunch of tech layoffs, or in 21, 22. But people quickly realized that a lot of those tech layoffs came with some pretty good severance packages. So you didn't really see much of an impact on consumer spending there. So if folks get an 8-month severance package, they'll probably spend it. So it'll kind of continue to show up. And by the time we get later in the year, we'll know exactly how many people potentially took those, and how many job losses you saw in the public sector. But again, in the private sector, where more cyclicality is, we are seeing some green shoots, both in the data and some from some of our leading indicators. So this chart here on the left, this is actually an example of the HOPE framework in process. It's taking that housing NHB orders data and advancing it nearly 2 years and inverting it. And basically, where we are now, which this red dotted line shows, is we're basically getting past now the 2-year anniversary of the sharp decline in housing in 2022. So, which again, none of these are perfect. I don't like using regressions and stacking the deck with a lot of variables to get a good fit. I like to look at things individually and think of things that have some kind of knock-on effect. And so we're roughly 2 years past that bottom in housing. And we've seen somewhat of on this chart, it's an upside down L. And perhaps we'll see now an upside down L in unemployment. And that maybe we have peaked at 4.3%, and we may bounce around between that and 4% for the foreseeable future. But what this chart is suggesting, again, it's not a linear relationship, it's directional, is that we should be getting near the worst in terms of the lagged effect of tightening, which did flow into housing orders, profits, and in this chart, employment. Again, this is a great chart to make the point again. It's a lot easier to get direction and a lot harder to get magnitude.
Right.
And the difference between a slowdown and a recession is not direction, it's magnitude.
Very true. And hey, the reason why I love the HOPE framework is it just shows us the data as it is, right? So we can have all these theses about where things are going, but at the end of the day, reality is going to be what reality is going to be. And,
Yeah.
having this data to kind of keep us in check is super useful. Let me just ask you a question that I had coming into this discussion, looking at well, it could be any one of these charts because they all have the unemployment rate on them.
Yep.
But the chart there, the left here, top left, goes back to 1985. And we
Yep.
see every time that employment's gone through a bottoming process, unemployment's gone through a bottoming process, it has then spiked.
Yep.
Um, it may not do so now, is what you're saying.
Yeah.
So
Well,
clearly
it,
that's aberrant. How much of a surprise would that be for you?
well, having, being wrong in 20 in much of 2023 on the recession and looking back uh, on potentially why we were wrong and why the magnitude wasn't as great as history would suggest. Our view, my view changed in late 23, and we ironically were bullish on equities because we thought the unemployment rate would continue to grind higher in 2024, which it did through August. Why is that bullish? It was bullish because everyone's focused on interest rates and Fed tightening and inflation. And what's the cure to that fear? It's a higher unemployment rate. So ironically, the cure to inflation concerns and a Fed that's tightening is a higher unemployment, lower rates, and between April and July, we had a melt up in equities as the unemployment rate went up and interest rates fell. So as you can see on the chart on the right, I think kind of 4.5 is of the level, which I don't think we'll get to, at least not this year, in this cycle. That is where we go from people viewing higher unemployment rate as a good thing to give us more rate cuts to a bad thing. And that's been my kind of line in the sand uh, that we obviously haven't gotten to. But for the last basically year and a half, we've been bullish on equities because we saw that as, again, kind of a catalyst to create a pivot. So
The classic when bad news is good news for the
yeah.
market.
Oh, there it is. I mean, that's exactly what, that's what it is. And so from here at 4% on the unemployment rate, and today the 10 years trading around four, almost just under 4.5. If next 2 months unemployment rate ticks up 4.1, 4.2, I think that's a pretty good backdrop for equities, surprisingly, because again, I think people want the Fed to cut, and they are 2022 just dramatically changed investor behavior, policy behavior, consumer behavior. And unless we get a crash in economic growth, softening at a time when interest rates are high is viewed as a very positive thing, a very hopeful thing, no pun intended. And so going back to, you mentioned earlier, we have refi issues. People are worried about the deficit. We've got commercial real estate that's frozen in many parts. We've got residential real estate that's frozen. So you have these companies, these zombie companies in the Russell 2000 with no earnings and high interest expenses. So interest rates coming down just from a softening of the economy, it could be still a bullish thing for equities to a point. And I think we're decently away from that point right now. And so let me just show you a couple other charts that I'm looking at that are these green shoots I mentioned. So I by no means to say that, again, I'm not trying to say that, well, the housing story is what's giving me confidence on the employment story today. Again, it's a piece of the puzzle. There's obviously so many things that I can't model, can't quantify, that are impacting the economy, employment, and all of these metrics. But when I can, but we, as analysts and investors, you have to find some base of a starting point, and we can't know all the unknowns. And so this is another example of a green shoot. When we look back, and this chart goes back to 1990, because it's using temp employment. So temp employment is the first thing to get worse and get better. It's the first thing to go, first thing that's cut, and first thing that's kind of rehired. And so what I'm showing here is it's the unemployment rate again in dark blue. That is on the left scale. And then I am taking a year-on-year change in temp employment. I am inverting it and pushing it forward a year. And so that clear? So
Yep.
I'm used to looking at these charts all day, and I can understand it, but for some people it may be a little confusing.
Yep.
So if you
Nope.
look
Time shifted. We get it. And
yeah,
inverted and time shifted. Yep.
yeah. So if you look to the right, you can see the current example. So basically, the growth rate in temp employment had deteriorated, that gray line going up. Remember, it's inverted on the right scale, all the way to about negative 10% in 2023, because it's pushed forward a year. And so we're basically, again, is it a coincidence that the unemployment rate kind of is peaking here or may have peaked? Maybe, but having this data at least gives me some confidence on something that's been historically, we only have 3 recessions in this history. I'm not going to obviously include COVID because that wasn't a real business cycle story. But what we saw in those past cycles were also that the temp employment growth hit its worst, and then about a year later, unemployment peaked. So that gives me confidence. Certainly seeing the PMIs improving after a Fed easing cycle
Yeah.
of some sorts gives me confidence. And then if we look at, really the heart of labor growth in our economy, small businesses, not too far. What we've seen over the last 9 months or so, or actually 12 months now, is hiring plans, which are again inverted on here and shifted a year forward, go from 10%, which is the peak of that red line on the right scale, and now is improved down to about 19% as of the last this last month's reading. So again, is some of that because of the election? Of course. Is there a right-leaning bias in the NFIB data? Absolutely. But that's been true for most of history, actually, if you look at the data. And so again, this is giving us, again, a green shoot at a time where the unemployment rate and other green shoots is stabilizing and other green shoots are showing up. So from a cyclical hope perspective, it looks like, we're going to see housing kind of bounce around as a reflection of what rates do. I think PMIs are going to improve, which all else equal should keep interest rates elevated on the long end. Profit breadth should improve on the back of rising PMIs. Those go very much hand in hand. And I think employment is probably, at least for now, plateaued at this high level of or at the current level of unemployment. Could we see a weak data month? Sure. Could we see a strong data month? Yeah. But I think we're stabilizing, and it kind of follows suit. And, there's a lot of unknowns which could change the path. And like the Fed, we're going to have to be a little data dependent still.
All right. Well, that's a fantastic summary. And I very much appreciate it because we've had a lot of people on the program recently who have had a pessimistic view about where things are headed in 2025. And one, I love to bring in different analysts who have, different look at the world so that the audience can determine whose approach might resonate more with them. But again, as I said earlier, what I really appreciate about the Hope framework is, and how you use it is, you might have a general kind of gut feel where things are going to go, but you have to map that against the data and say, look, if the data is not supporting of that, I got to potentially change what I think. And you did that with your recession outlook, as you've said several times. So, and I'd love to have a story to tell people here that, like, hey, maybe things aren't going to be so bad.
Yeah.
Right?
Well, I'll if you're willing to take the other side of the bet, I bet you're going to get a lot of comments. Well, look, Kantrow's bullish on the economy now. It's probably going to head a recession.
Well,
and listen,
I mean,
I wish I had that much power on anything.
well, I was going to ask that in the sense of less so much about a recession, but look, if you see a change in trajectory from what you've just shown us here that concerns you, obviously, Michael, you got open invitation to come back on this channel and let us know anytime. But we've had a lot of these indicators in recessionary levels or giving recessionary warnings for a couple of years, and yet the stock market didn't care. Stock market actually performed great, right?
Yeah.
Could we potentially be entering into a new era where the macro data starts improving, but the market performance starts deteriorating? And that could happen for a lot of reasons. One just being valuations being too high. So I'm curious, and this is a good sort of segue here. What are your thoughts about the market's performance in 2025 here?
Yeah. And the answer to your question is absolutely. And I'll show you a few charts. So I think to answer that question, we have to think about, another way to say bad news is good news is, and good news is bad news is looking at the correlations of interest rates and equities. When they're negative, bad news is good and good news is bad, i.e. things that push up interest rates pull down equities. And so We are still in a negatively correlated environment. I look at a 6-month weekly uh, price changes in interest rates in the S&P 500. And as of last Friday, we're at negative 0.31 on the rolling 6-month correlation between the 10-year and the S&P. And it's been my view for the last couple of years, and all this work essentially is what turned me bullish in late October 2023, was recognizing that we had a regime shift, and that actually softer unemployment. I didn't get more bullish on the economy. I just thought that softer unemployment in 24 would lower rates and lift equities. So we're still in that territory, and I think for the foreseeable future, not every day, not every week, it's going to feel like this, but more often than not, we're going to see negative correlations. You know, it's not a coincidence that the S&P bottomed out in the middle of January when we had that dovish CPI report, when the 10-year was at 4.7 and change, and now we're 30 basis points lower, in part because we got a good CPI reading about 3 weeks ago. And so, yes, we could see a backdrop where the economic data sharply improve and interest rates go up, and a lot of parts of the equity market don't like it because, again, refi risks are still present. Housing doesn't get better if rates move higher, nor do any of these concerns around interest rates. And so that's why we've had this negative correlation now for the last 2 years, and I think for the foreseeable future we're gonna continue to be in there. You tell me when people are going to start dissecting CPI to the third decimal place, and I'll tell you when we can see interest rates go up and stocks go up together. And there's a chart I want to show you here because I get a lot of pushback on this idea that, well, look, over the last 2 years, interest rates are up and equities are up, and that's true. However, this is a cool chart. If you break down by week from 2023 through present. So here, the S&P 500 is up 60% since the beginning of 2023. Now, if we only look at the weeks where interest rates were up, the S&P is actually down 5%. And then if we look at the cumulative return of the weeks where interest rates fell in a given week, the market's up 67% of the time, or 67%, not percent of the time, 67%. So it has really, and we all know, like, markets spilled over pretty ugly in the summer of 2023. We had about a 5% correction in April of 2024. And then coming into this year, we saw a market breadth peak in mid-September, and then equities, corrected a little bit, not 10%, but 5-6%. Small caps gave all their post-election returns back, as I think did the S&P. And it was because rates were going up to 4.75, and people were starting to ask me at every meeting, is the Fed going to hike this year? So I still think we're very rate sensitive, and too good of data could lead to those risks coming back. Now at 4.5, I think some of that fear has cooled, but I think above 4.5 and rising becomes a problem. And part of my story is that, right, ISMs are going to improve, and if we look throughout history, when PMIs go up, and you can see it here in this right chart, rates are usually going up too. So it's a little bit of a double-edged sword, which is really unique for the market, because typically the best time for equities is when the ISM manufacturing index is below 50 and rises back up towards 60. That's a backdrop. You often get earnings breadth improvement and PE expansion. I'll just show you a couple of those charts. I've already showed you this chart, so that's the earnings breadth improvement. Here's a table. It may be a little hard to see, but it's a table of annual returns back to 1985. And all the way on the right column, I've circled the years in which PMIs rebounded. On average, PEs typically are up 20%. So again, these are the best time for equities. However, why do PEs expand by 20% when PMIs are improving? It's because the starting point is usually one where people are worried about growth. Credit spreads are wide. So this is a chart of the ISM with credit spreads inverted. Today, it's grayed out here on the right, but you can see it. We are at the lowest credit spreads on this chart. Why? Because, as I mentioned earlier, I think largely because no one's worried about or the pricing in of risk around inflation, tightening, and recession have all gotten largely priced out over the last 2 years. And I think part of that actually was thanks to a weak small business backdrop, thanks to a weak manufacturing economy. That's why the Fed cut, to help those really struggling sectors of the economy and the market. And so we could see a backdrop where the ISM does move up sharply, rates move up, and we get towards 5% on the 10-year, and the market starts to panic a bit. And all the hawks start to come out, and everyone blames the deficit and whatever else. But we are certainly in a new normal, and this obsession and sensitivity to rising interest rates in an economic backdrop that's improving is really rare. And that's why I think this year is going to be really atypical. And instead of getting a 20% increase in market multiples, that again come when credit spreads sharply compress, you're going to get at best whatever earnings will produce. We think earnings growth will be somewhere like 8, 9, 10%. So it'll be broader, maybe not as strong as the street expects, but perhaps broader than the street expects. And maybe we'll get lucky and we'll end the year with the PE where we are today. If rates go higher, we'll probably see some PE compression. If rates go lower, people get excited, and maybe PEs can kind of levitate around where they are now.
Okay. Wow, super fascinating. And I kind of feel like this episode has been like a hope framework with an asterisk, which is a framework still doing what it needs to do, is very useful, but it's somewhat terra incognita, that this is just a different nature of the cycle than we've seen much in the past. And so continuing to watch the data is going to be especially important as we go through 2025 here. As we wrap this up, and I mean, I could keep going for hours, Michael, with you. And I sense we just scratched the surface of your charts there, but sadly, we've already gone over the timing that I promised you we'd keep it to. Let's zero in on, okay, so what does this mean for you at Piper Sandler in terms of, what you are looking for in terms of managing this from a investing standpoint for the rest of the year? Clearly, you've got some concerns about valuations, just where they are in general. You've got some reasons for optimism here based on the green shoots, but then you've also got some concerns that, hey, maybe these things won't work the way that they used to do, right? As you just said, maybe this historically great period for equities might actually turn out not to be such a great period for equities. So how are you advising investors and your customers to think about how to navigate this? Are there certain asset classes you'd stay away from? Are there certain strategies that make more sense in this type of environment? How are you planning on surfing this?
Yeah, so I'd say I'll pull up one page just has some conclusions. We generally, I think our work is a bit different than the typical strategist that just gives a market target and some sector overweights and underweights. We have for like 7 or 8 years now, have increasingly gone into recommending stock portfolios and baskets based on factor themes. So if you were to ask me what are my favorite sector overweights today, I'm going to answer that in a very different way. I'm not going to say healthcare or financials or industrials. I'm going to say companies with high free cash flow yield, with strong earnings revisions, with high profitability, companies or stocks that have sensitivity to PMIs that have been struggling for the last 2 or 3 years that may actually now see some green shoots as that PMI data improve. So that is kind of a bit of a call it a mid-cycle positioning or a late early cycle positioning. The classic risk-on early cycle positioning in a PMI recovery, again, is unlikely to play out, in my opinion, because housing's not going to broadly rebound, which it has historically on PMI rebounds. Credit spreads are already tight, and interest rates are still elevated. So we're not going to get all that fuel that typically allows for a really low quality, small cap, deep value, emerging markets, Europe leadership, or at least one that's so strong it's, or seems so obvious. I understand that small caps are still cheap relative to large caps, But again, they are also reflecting a macro and market environment that's not really worried about a whole lot right now. And so I would say those are the types of stocks we would prefer to kind of lean into. The last 2 years, Adam, every time you and I have spoken in terms of positioning, we've been a broken record and just recommending quality growth. So profitable stocks kind of on the right side of that curve. So this switch to the quality cyclicals part of the curve, if you will, is a big change for us. And I think it's a change that's warranted given all the data and green shoots that we're seeing ahead of us and today. And so that's kind of we think about it. I think we're going to see a market, equity market that's up mid-single digits. I don't think it's going to be a 20% year because spreads are already so ridiculously tight. And I think the best periods for equities are still going to be when rates are high and falling. So we just went through that in early January, where the 10-year was about 475 and falling. If we get back down near 4.25 or just slightly below there on the 10-year, I would be taking the other side of that trade because I do think we're going to be bouncing back and forth between 4 and 5% roughly. And so I think the risk reward looks more attractive or less attractive when we get near those extremes. So a lot of interest rate sensitive stocks like biotech, real estate, home builders, companies without earnings, long duration growth, they're all going to be very volatile this year if indeed we're right about interest rates just kind of bouncing up and down throughout the year. In a way, the economy is too strong to see rates go below 4 on the 10-year, and there's too many problems in the economy that would allow interest rates to go above 5 for any sustainable period. So it kind of keeps us trapped in going back to this bifurcated equilibrium that I think we're stuck in. Other asset classes. So, there's a lot of the policy changes in the U.S. are definitely more positive for the U.S. And so as long as the U.S. data stays healthy, I think the dollar is going to stay strong. Tariffs could exacerbate that. So I say we're still bullish on the dollar. Usually in a PMI recovery, it's a backdrop where you want to go from U.S. large cap growth to emerging market beta. But again, this is, I think for many reasons that we've touched on, this is not your typical playbook. And so I would be looking for improving. I would look to broaden out my portfolio. I think there's now some reasons to say you don't just have to hug the Mag 7. If we're going to get better fundamental breadth, we should see the U.S. outperformance of the rest of the world not be as great. Large to small caps, that gap not be as great. And so I kind of like the middle. I'm not really bullish on value or growth. I'm kind of more core or blended. So staying with higher quality, that's staying with stocks that don't need rates to collapse, that don't need credit spreads to collapse, that are still growing their earnings in this backdrop, and maybe get a little bit of a kicker if we get some positive cyclicality in the data. So I can't really say, I mean, my view on treasuries is going to be more tactical. Moving from growth to value, or I would say growth to cyclicals. And regarding the rest of the world, there's a lot of the uncertainty that is still out there is going to be, from President Trump's policies and how those play out. So again, I think we're going to have to be a little data dependent, but an improving backdrop in PMIs in the U.S. should lead to some stabilization around the world. Again, I don't think Europe's going to be booming anytime soon, but any improvement there, I think, given how lopsided the global investor community is in U.S. equities in Mag 7, you get a little trickle out there. And so again, this is a backdrop where you could maybe rebuild some parts of that in your portfolio, but I wouldn't go full tilt recovery or full tilt risk or full tilt low quality.
Michael, I just took a truckload of notes based on that. Thank you for being so transparent and so granular in your transparency about your playbook and everything that you look at. I very much appreciate, and I believe you call this sort of a factor based investing approach, looking at companies that have different types of factors as opposed to like, well, it's this sector or whatever, right?
I care about how well a company operates, not which sector they operate. Think of it like a technician. They can look at a stock. They don't need to know what sector it's in, what industry it's in. So when we find just so much more consistency in investing that way, as opposed to trying to time sector rotations, especially in this backdrop where, again, I think there's so much uncertainty and narrative volatility.
All right. Well, look, thank you again for coming on, for giving us both just the general update and the hope framework, but for again, really parsing it all out for us. And I think we should take from this a degree of optimism that, hey, maybe indeed we did avoid the hard landing economically, and maybe there's something building here that we can maybe perhaps a more optimistic longer term outlook here over the next couple of years than maybe many folks who have seen a lot of the recent people on this channel have taken away. But again, like I said, Michael, you've got just carte blanche to come back on here anytime. If you are seeing notable changes in the hope data here, whether it's a worsening or a further improving, would love to hear what it is. For folks that have really enjoyed this discussion, but really enjoy your approach, your framework, and would like to follow you in your work, where can they go?
Sure. We have a brand new podcast we started about a month ago. The title is What's Next for Markets. That is on Apple, Spotify, YouTube, etc. You could follow me on Twitter. My handle is at Michael Kantrowitz. And if you're an institutional investor and you're interested in getting research from Piper Sandler and the macro team, you can reach out to Piper Sandler, or you can DM me on Twitter and go from there.
Fantastic. Michael, when I edit this, I will put up the links on the screen here to your podcast, to your X handle, and to Piper Sandler. Folks, I'll also have the links in the description below this video too, so you can get there with one click. I also want to say Michael has been very generous in sharing his most recent report with Thoughtful Money's premium Substack subscribers. So folks, his latest report is going to be the Macro Pass for this week. So if you're watching this video the day it comes out, Macro Pass should be coming out, I think, the day after. But anyways, thank you so much again for that, Michael. All right, very quickly, look, Michael's firm generally deals with professional investors. Obviously, if you're a professional investor, institutional investor, want to get more of their work, more exposure to Michael, go to pipersandler.com. If you're a regular person and looking for some help in navigating all that Michael laid out for us here, highly recommend that you get the advice of a good professional financial advisor in making whatever changes you want to make in your portfolio around that. Just make sure your advisor takes into account all the macro issues that Michael and I talked about here. If you've got a good one who's doing that for you, great, stick with them. But if you don't, consider scheduling a free consultation with one of the financial advisors endorsed by Thoughtful Money. These are the firms you see with me on this channel week in and week out. To do that, just go to thoughtfulmoney.com, fill out the short form there. Only takes you a couple seconds. These consultations are totally free. There's no commitment to work with the firms. It's just a free public service that they offer. All right, folks, please let Michael know how much you appreciate him and being, again, as granular and transparent as he was by hitting the like button, then clicking on the subscribe button below, as well as that little bell icon right next to it. Last bit of housekeeping here. If you have not yet bought your ticket for Thoughtful Money's upcoming spring conference, make sure you do that now while we're still offering the lowest early bird price. To do that, just go to thoughtfulmoney.com/conference. And a reminder that premium Substack subscribers get an additional $50 off with the code that I've emailed you. Michael, again, thanks for everything. Very quickly, most folks who are watching this channel are folks that are just working hard to, build wealth for them and their families. They want to grow that wealth prudently over time. Probably even more importantly, they don't want to lose it in a big market turn down. So they're cautious, prudent investors. What parting bits of advice would you have for them as we head into the brunt of 2025?
Sure. Well, I would say, when you make an investment and as you hold that investment, always have an exit strategy so you can avoid remaining in something too long or for different reasons than you originally got involved in. I've certainly learned that lesson over my career, and I've seen others learn the same. So, do your work, understand the risks as best you can, and remind yourself a year later, 6 months later, why you got into that investment and whether it still makes sense.
That's a great point. One that a lot of investors, a lot of regular retail investors, I think they're guilty of not following, right? They get very excited. They hear about a stock, they research, they think they see an opportunity, they buy it. Then life gets busy. And then you look at your portfolio quarter or two later, a year or two later, and you see that this securities in there, but you're like, why did I buy it? Like,
Yeah.
does it still make sense to own now? And so this is a big reason why I encourage people to generally work with an advisor, whether it's to follow a firm like yours or to actually get a advisor to be their financial quarterback. All right, Michael. Well, look, can't thank you enough. Really appreciate it. Like I said, anything changes in terms of what your data is telling you, please come on this channel.
Absolutely.
As soon as that does, let us know. In the interim, folks, go watch Michael's new podcast. It's excellent. And Michael, can't thank you enough.
All right. Anytime, Adam.
All right, everybody else, thanks so much for watching.